Higher for longer seems to be the name of the game. At least that's what more central banks are starting to believe. European central banks, Joachim Nagel says the ECB isn't yet at a point where it should consider reducing borrowing costs. Nagel says, he went on to say, quote, it would be premature to lower interest rates soon or to speculate about such steps. So, Sean, it's safe to say the overall vibe on the street is still, I guess, a little pessimistic, dare we say, or just this kind of cautionary tone about let's see how this all plays out, whether we're talking about it over in Europe or here, this theme about seeing what the overall impact will be for this longer stretch of higher interest rates.
Yeah, I think the vibe maybe of policymakers, it's safe to say that it's a little bit cautious. I think what you're seeing from strategists, at least in terms of their outlooks here for 2024, there's a relative surge in bullish sentiment, I think it's safe to say. We were talking to Brian Belsky off the top of the show there, out with a 5,100 price target, or year-end target for the S&P 500 for next year. And he was talking about the fact that higher for longer, in his view, is one of the most overused phrases of 2023, and it's more so this normal for longer, this return to normalcy with rates settling at higher levels, and really what we have seen for the last over a decade. Obviously, when you take a look at some of the changes that we have seen in policy and exactly what has played out since the great financial crisis back in 2008. But this elevated inflation, obviously, meaning that central banks from around the world, they're going to need to keep rates higher than maybe the street anticipates right now, or the street was initially anticipating. Exactly how high and how long is the question out there. Almost every single strategist, economist is debating up until this point. But it's no secret that this puts more pressure on borrowers just in terms of their ability to repay debt. The credit costs for increased substantially here for borrowers when you take a look at rates today compared to what they were a year and a half ago. Exactly the impact that this is going to have on the broader economy, not only here in the U.S., but you take into account what central banks around the world are doing, what it's going to do for a global economy. We certainly have seen a number of forecasts in terms of slowing growth, obviously, not only for the U.S., but also what we're starting to see abroad.
To your point, the impact on whether we're talking about the cost of secured versus unsecured debt, it's certainly pricier to take on this kind of debt, whether you're talking about, again, here in the U.S. or overseas. And then that question mark about where inflation is. Headline inflation has cooled across overseas or here in the U.S., but it remains to be seen whether this is where central banks can put a pin in it and then move to eventually cutting rates, or just seeing how this plays out. Is this where inflation continues to cool?